The lie everyone loves. Everyone tells you investing is a magical escalator to wealth. Just step on, wait, and one day you're rich. I learned the hard way that markets don't reward hope, they reward structure, discipline, and brutal honesty with yourself. Today we're breaking the fantasy and building a system that actually survives real life. What this video will actually give you. Instead of promises of overnight millions, you'll get 5 non-negotiable foundations that must exist before you buy any asset. Miss even one, and investing becomes a slow financial leak. Stay until the end because the 5th foundation is where even smart, wealthy people lose everything. Foundation 1. Destroy toxic debt. Why debt kills investing before it starts. Investing with high-interest debt is like running on a treadmill that moves backward. If your credit card charges 25-35% annually while your investments may average 10-15%, you're mathematically losing before the race begins. Numbers over emotions. Your emotions scream, buy stocks now, but numbers don't care about hype. Eliminating a 30% loan is equivalent to earning a guaranteed 30% return, something even elite funds rarely achieve. Nuance matters. Not all debt is evil. Low-interest mortgages or inflation-beating loans can be strategic leverage. But consumer loans, expensive car financing, and revolving credit card balances are financial quicksand. The deeper you step, the harder it is to escape. My personal lesson. A different story. Years ago, I tried active trading while carrying a big gadget loan. One bad week wiped out months of savings, while the bank kept charging interest. That's when I realized the first profitable trade is often paying off your worst debt. Foundation 2. The Freedom Fund. The real purpose of an emergency fund. Your emergency fund is not for vacations or gadgets. It's financial oxygen. Without it, a job loss or medical bill can force you to sell good investments at the worst possible time. Market drops are normal. Panic selling is not. Markets regularly fall 30-40%. Investors with reserves stay calm or buy more. Those without reserves become forced sellers at the bottom. The difference is not intelligence, it's preparation. What size should it be? I recommend storing at least from 4 to 6 months of essential expenses in safe, liquid accounts. That buffer transforms crises from disasters into manageable inconveniences. Foundation 3. Knowledge before action. Investing without understanding equals gambling. If you buy assets you can't explain to a teenager in simple language, you're not investing, you're guessing. Blindly copying anonymous tips or hype trends turns you into liquidity for smarter participants. I once watched a friend invest heavily in a trendy green energy startup simply because social media loved it. Nobody checked the financial statements or debt levels. Months later the stock collapsed. Hype is not research. What you actually need to know. Understand basic concepts. Stocks versus bonds, diversification, inflation, interest rates, and risk tolerance. If deep research is not your strength, broad index funds may be your safest long-term option. Foundation 4. Strong cash flow. The truth about small investments. Compound interest is powerful, but slow when contributions are tiny. Investing small amounts without increasing income rarely leads to real financial independence. Investing is an amplifier, not the engine. Your main wealth engine is your career, business, or skills. Early in my journey, I spent hours analyzing charts instead of improving my earning power. And that was a costly mistake. Build skills first. Learning negotiation, technology, languages, or sales can double your income faster than most portfolios grow. Higher earnings mean more capital, and capital accelerates investing results dramatically. Foundation 5. Psychology and time horizon. Your brain is your biggest risk. Humans feel losses more intensely than gains. I've felt that pressure myself. Wanting to sell just to stop the emotional pain of seeing red numbers. Create rules before emotions hit. Before investing, I write down what I'll do if my portfolio drops 20 or 30%. Pre-planned actions keep emotions from hijacking rational decisions. Long-term thinking wins. Money needed within a year shouldn't be in volatile assets. Stocks reward patience across from 5 to 10 plus years, not short-term speculation. Investing is endurance training, not a sprint race. Conclusion. The 5-step blueprint recap. Eliminate toxic debt. Build an emergency fund. Grow income. Gain knowledge. Then invest long-term with emotional discipline. Change the order, and you risk building wealth on sand. Honest self-check. Ask yourself today. Do you have high-interest debt, no safety net, or unstable income? Awareness is not failure. It's the first real step toward financial control. Action task for today. Write down every debt, interest rate, and monthly expense. Rank them from most expensive to least and create a clear elimination plan. Momentum starts with one honest list. Join the journey. If this video gave you clarity or saved you from a costly mistake, like it and share it so more beginners avoid financial traps. Subscribe for clear, hype-free financial education and write in the comments which foundation you're working on right now. Let's build smarter money habits together.